Here's what most people get wrong about wealth. They think the wealthy are paying more taxes because they make more money. Wrong. The wealthiest people in America often pay a lower percentage of their income in taxes than you do. And the crazy part? They're doing it all completely legally. The difference isn't that they're breaking the rules. It's that they know the rules that most of us completely ignore. Today, we're breaking down exactly what those rules are, so you can start using them right now, regardless of your income level. Let's start with the foundation. The 3 accounts the wealthy max out first in order. Number 1 is a 401k or similar employer plan. If your employer offers matching, that's free money. Literally, an instant return on investment. In 2025, you can contribute up to $23,000 to a 401k. Number 2 is a backdoor Roth IRA. Most people don't know this exists, but if your income is too high for a regular Roth, you can still contribute to a backdoor version. That's another $7,000 annually that grows tax-free forever. Number 3 is an HSA, a health savings account. This is the most underrated account in America. You can contribute for this as an individual in 2025. And unlike FSAs, it rolls over. It grows tax-free, it's invested, and you can use it for any medical expense. That's nearly $35,000 per year in tax-advantaged space if you're doing all 3. But here's where it gets interesting. Timing and deductions. The wealthy understand that when you earn money matters as much as how much. If you're self-employed or running a side business, you can bunch expenses into high-income years and spread income across low-income years. That's not dodging taxes. That's strategic income recognition. Then there's charitable giving. A donor-advised fund lets you make a large charitable contribution in a high-income year, get the deduction immediately, but distribute the money to charities over time. Someone earning $200,000 might donate $50,000 to a DAF in a bonus year, reduce that year's taxable income by $50,000, and then give $5,000 per year to their favorite causes over the next decade. Same impact on charity, massive impact on taxes. Now let's talk about business ownership, probably the biggest wealth-building advantage the wealthy use. If you're an employee, you pay taxes on your full salary. If you're self-employed or own a business, you get deductions. Home office, internet, a portion of your car, professional development, software subscriptions. These come off your taxable income. Someone earning $100,000 as an employee might owe taxes on $100,000. That same person earning $100,000 through a business might deduct $20,000 in legitimate business expenses and only owe taxes on $80,000. That's a real difference in what you keep. The wealthy know this, which is why so many of them have business entities or side ventures. It's not always about the extra income. It's about the tax efficiency. Investment strategy is another layer. The wealthy don't just invest. They're intentional about where they invest and when they sell. Long-term capital gains are taxed lower than short-term gains. So instead of trading stocks constantly, you hold for over a year and get preferential tax treatment. Tax loss harvesting is another one. If you have a losing investment, you sell it to offset gains elsewhere, then immediately buy a similar investment. You've reduced your taxable gains without actually reducing your portfolio. And qualified dividend income, dividends from stocks held over 60 days, get taxed at lower rates than ordinary income. These aren't secrets. They're just principles most people never learn because they never read the tax code or talk to a financial advisor. Here's the reality. You don't need to be rich to think like the wealthy. Right now, before the end of the tax year or next January, do 3 things. First, calculate whether you've maxed your 401k and Roth accounts. If not, that's your first move: immediate tax savings and long-term wealth growth. Second, if you have any business income whatsoever, freelance work, consulting, a side gig, talk to a CPA about entity structure. An S-Corp or LLC could save you thousands annually. Third, if you're earning above the average income for your area, consider a donor-advised fund and map out charitable giving for the next few years. These moves aren't complicated, but they compound. The difference between someone earning $150,000 and keeping $110,000 versus keeping $105,000 is $5,000 annually. That's $50,000 over a decade with no additional effort, just smarter structure. The biggest wealth gap isn't about income, it's about knowledge. The wealthy don't pay less in taxes because they're smarter people. They pay less because they understand the rules of the system and use them intentionally. Those rules are available to you right now, regardless of your current income. The key is starting before you need to, building these habits into your financial routine, and talking to professionals who understand your specific situation. Your situation is unique, and that's why this video is educational, not financial advice. Please consult with a qualified tax advisor or CPA before making any moves. But now you know what questions to ask and what levers exist. That's the real advantage the wealthy have. They know the game before they start playing it. If this made sense to you, like this video and subscribe for more personal finance fundamentals that actually move the needle. We break down investing tips for beginners, stock market basics, money habits that build wealth, and how to optimize everything from your 401k to your side income. The wealthy aren't keeping these strategies secret. They're just not teaching them in schools. So let's level the playing field, subscribe, and let's build your wealth foundation together.